Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Innovative Approaches to M&A Deal Structure for Firms Seeking to Merge Up or Sell. Before we begin, we need to cover a few important items. First, please close any other programs that are running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASDA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. First, you must participate in all 3 of the polling questions throughout the presentation. And please note that GoToWebinar does monitor your participation in the polls. Next, a link to an evaluation will be emailed to you later this afternoon, and that must be completed before we can email your CPE Certificate of Completion. Now, this is slightly different for those of you who registered through CPA Academy. Additionally, a very brief survey for the webinar will pop up immediately after the session ends for everyone, so please take just a moment to complete our survey before you close the browser. In order for you to fully participate in the webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel, which should be on the right-hand side of your screen. The orange arrow near the top will minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box toward the bottom of the panel. Just type your question and click Send. Questions are important to us, and today's presenter will answer your questions at the end of the presentation. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. You can see a list of upcoming topics there, including the second part of today's session, which is for firms seeking to acquire for growth. And we also have sessions on valuing your accounting practice, both specific to Texas next week and then a more general one in June. For a complete list of webinars, including the links to register for them, you can visit the CPE Courses section of transitionadvisors.com. So just a quick reminder that in the email that you received, the reminder email, you received a link to today's slides, but I also just sent it to you via the chat function, so you can click that if you'd like to download and follow along. If you'd like to email me, if you'd like for me to email you a PDF after the webinar, just indicate so in that evaluation that pops up, and I'm happy to send you a copy of the PDF. Now I would like to introduce our presenter for today's session. Terry Putney is CEO of Transition Advisors. Thank you for attending, and we hope that you enjoy the webinar.
Hello, everybody. This is Terry, and I thought I'd just start off with a little bit of an introduction of our firm so you understand kind of who you're listening to. We are a national consulting firm. We work strictly with accounting firms on issues related to ownership transition. The services that we offer generally are around helping to facilitate mergers and acquisitions. We identify the parties. We help with negotiations, structuring deals, documenting the deals, helping with all the process from start to finish. We also provide support to firms who have found their own potential merger and acquisition partners by providing the same services we provide to firms where we make the introduction. And then in addition to that, we offer several practice management type services which are mostly related to succession planning and owner agreements. We do help structure new owner agreements where firms either don't have one or have one that needs updating or needs to be to address specific situations that they're dealing with now that they weren't when they put the original agreement together. You know, if you're on this presentation today, I have to assume that you're looking potentially for a solution to what to do with your practice or maybe your portion of a practice if you're in a multi-partner firm. I wish I could talk to each of you individually on a one-on-one basis and address your specific needs. That's generally how I operate when I work with firms, and I find that there's no 2 firms and no 2 situations that are the same. But based on what we generally hear from firms, we've put together this presentation which addresses what hopefully will address what your needs are. If we don't find something, or if we don't talk about something you hope we would talk about, or if you want to delve further into a topic that I bring up, I'd be happy to discuss it further with you on the phone. But what might be on your mind is that what we find a lot of times is that firms are saying, look, I don't really want to retire. I've got a problem with succession long term, but I'm not ready to quit. I don't want a boss. I mean, oftentimes when I talk to a firm about the potential for an upstream merger, the first thing they tell me is I don't want to become somebody else's clock-punching employee. So that oftentimes keeps them from taking action against their succession plan. I really don't have anybody in the firm who I can leave my practice to, or I don't have the right people to take over. I mean, I've even heard senior partners say that about junior partners in their firm. They're just not confident that they've got what it takes and that there's enough of them to provide succession from within the firm. And of course, if you're a sole proprietor, there's a very good chance that you don't have that talent on your bench, or they'd probably be a partner of yours already. How and when should I address this? If I know I'm going to be leaving the firm or want to slow down in, say, 5 or 6 years, what should I be doing about that now, if anything? What's my firm worth? That's generally the first question I always get in my live seminars from the audience is, what are firms going for these days? How do I find a successor? Because most of us know we need to do something about this now, but we're not ready to keep working. Is it possible for me to find a successor, keep working, make the same income I have now, but know that I've got my succession plan in place? Why should I be worrying about this if I'm not ready to hang it up? Is it a seller's market? Is it a buyer's market? I think most of us are hearing both. Needless to say, with the increase in the number of firms that have succession issues because of the baby boom generation, I don't know if you know this or not, but there's roughly 77 million baby boomers. I happen to be one of them. And there are only about 50 million people in the next generation, which are Generation Xers. So there's obviously a problem with having enough people to take over for all of us that will be retiring in the next 10 to 15 years. So, but if I'm not ready to hang this up now, why should I be worrying about it now? And we'll talk more about that. And then, of course, is it a seller's market or buyer's market because of the influx of all the baby boomers? How's the market going to change in the near future? Is it likely to keep going one way or the other? And what will make my firm more attractive to a buyer? What about my staff? What's going to happen to them? It's oftentimes the case that one of the first concerns, of course, is what's my firm worth, and the next concern is what happens to all my staff. Some of them may have worked for me for 20 or 25 years, and I want to make sure they're taken care of as well. How do I make sure I'll get paid? That's a big concern because so many deals involve multi-year payouts. How do I know if this buyer that I'm talking to is the one that will keep my clients and even wants my clients? And finally, how do I maximize the value of my practice when I do so? You might all remember Jerry Maguire, and that kind of comes down to, well, what's the multiple? Everybody wants to know what the multiple is. With that, we'll go into our first polling question. Nikki?
Okay, the first polling question is launched. You should be able to see it there on the screen. The number of owners in my firm is I'm a sole proprietor, 2 to 4, 5 to 9, or 10 or more. So take just a moment here to select the answer. And keep in mind you do have to do all 3 polling questions in order to get the CPE credit today. Okay, it looks like nearly everyone has had a chance to answer the polling question. I'll share the results there. Terry, to let you know, we have 57% are sole proprietors on the call today, 28% 2 to 4, and then 6 and 9% respectively for the last 2 options.
Okay, which is kind of what we expected here. You know, when we talk about value, many of us think of, our practice or a portion of the practice like we think of our house. When we're going to go sell it, maybe we should just find out what the practice is worth, talk to somebody like a broker or a consultant or somebody like that, or maybe a friend of ours who sold their practice, try to figure out what it's worth, figure out some way to list it so that we get enough people to talk to about buying it, and then, work hard to get the best deal you can to find it, so you'll get as much money as you can and get it as quick as you can. However, when you think about this, you're not selling a car. You're not even selling anything that's tangible. What you're selling is relationships. Now, you may have receivables. You may have some fixed assets. Fixed assets typically that you have aren't going to be worth much. I mean, how much is a used computer worth? How much is a cubicle worth? Not very much. But What you really do have, virtually probably 80% in most cases, sometimes 90% of the total value of your practice is intangible. It's relationships. It's relationships you have with your clients, it's relationships you have with your staff. And you really can't sell relationships. Obviously, we do sell them because we get money for the practice, but you really can't sell a relationship. You don't own it. Well, all you can do is try to convince your clients and your staff and the other relationships you have to start working with your hand-picked successor. And that's really what the principle of value is all about, is how do we get that done? How do we maximize that outcome? And if we think about it from that standpoint, we'll get the maximum value for the practice. So first, think about what creates value in the practice. Well, your practice value is primarily based on your ability and that of the buyer to successfully get your clients to transfer from your relationships to the buyer's relationships. Most of us think of the value of the practice being 1 times revenues, maybe 1.1 times revenues, maybe more, maybe less. Maybe somebody told you that your practice shouldn't sell for less than 1.5 times revenues. I was in a seminar once in 1998 where one of the speakers said you shouldn't sell your practice for less than 3 times your revenues. And then others might tell you, well, nowadays, because there's so many sellers, or maybe because where you're located, you'd be lucky to get 1 times revenues. So how do we know? Well, when you think about it from the perspective of someone who's buying a practice, turn it back around. Think about yourself as the buyer. What would you pay for a practice if you thought you couldn't keep most of the clients? Probably not very much. On the other hand, what would you pay for a practice if you thought you could keep almost all the clients? Probably a lot more. What if you don't have any idea whether you can keep the clients or not? When you talk to most buyers, honestly, they don't know. The first conversation you're having with them, they don't know your clients. They don't even know who they are. You probably haven't told them. They don't really know you very well, so they don't really have any really strong idea of whether or not they can keep your clients. Now, if they've done practices or bought practices before, they probably have an idea of how they've done it before, but how would that apply specifically to your situation? So the key to this is to make sure that you make the buyer as confident as you can that they can keep as many of your clients as possible. And when you do that, you're going to end up with a much higher value for the practice. Basically, the better you make the retention of your clients happen, and the better the plan you have for that, the more your practice should be worth. And don't forget that the other part of this is, of course, that the buyer's in it to make a profit as well. Not only do you need to convince the clients, but also the successor firm that this can be done. But it's done all the time. I mean, we successfully, help with the transfer of practices all the time at very good values. And it's just understanding what goes into that helps make that come out best for you. So rather than become one of those stories that you hear about where, well, I sold my practice and I thought I was going to sell it for, 1 times revenues, paid was maybe 0.7 because so many of my clients left. If we take the right approach to this, we can make sure that doesn't happen. So what's on a buyer's mind? What causes a potential buyer to not be interested in your practice or to not make you a great offer? One of those is uncertain transition plan for the seller. So if the buyer is looking at you and saying, well, how many more years do you want to work? And you're saying, well, I really don't know. I don't have any idea how much longer I want to keep working. That creates a tremendous amount of uncertainty for the buyer. How's this going to work out? How do I build a plan for the transition of this practice if I don't know how long you're going to be around? The smaller your practice, the more likely that the relationships you have are personal to you. In order to have a transition plan that's successful, we have to have a plan that is connected to your own personal career goals. So the more you can be certain with a seller going in, or with a buyer going in, about what your transition plan is, the more confident they're going to be in building a plan for a successful transition of the client relationships. Too many must-haves or have-to-haves. Examples of those would be you might have an office manager who's worked for you for 25 years. She's making $100,000 a year, and you knew, and everybody else knows that you could replace her for $45,000 a year, but you pay her that much because she's so important to you. Well, from a buyer's perspective, That's a lot of excess compensation. And if you go into the deal and say, look, you have to hire Sally, and you have to keep Sally, because I don't want Sally to get hurt in this deal, that creates a significant burden for the buyer and can result in either them not doing the deal or obviously maybe making you a less attractive offer because of that. Other have-to-haves might be the way you operate your practice might be significantly different than the buyer, and it's really not important to the client, but it's important to you because of the convenience factor. That's another example of a have-to-have. So the more things that you load on to the list that says, I have to have this, the less the fewer buyers you may find are interested, and the lower value you may get. Long unexpired leases. If you've got a lease that's got, say, 6-7 years left to go, and you're saying, look, you have to take this lease over, you got to assume it from me. Obviously, that ties the buyer's hands. Sometimes your space is full. There's no way to grow in that lease. And so now we're saying not only do you have to keep this lease for the next 5 to 7 years, but you can't grow either in that space. So there's a significant restriction you're putting on the buyer's ability to operate the practice. So the shorter the leases that you have, that's unexpired, the better. No meat on the bone. In other words, buyers buy practices to make money. And if the deal terms are set up so that they're not going to make any money, no cash flow, for say 3, 4, 5 years, then obviously it's going to be a less attractive deal, and they're unlikely to do it. Buyers are willing to go with a negative cash, maybe a year, maybe 2, but you get beyond that, and it's pretty difficult to motivate a buyer to do the deal. And that basically leads into the same thing of terms that don't cash flow. So if you can eliminate as many of the above issues as possible, you're likely to find more buyers interested in the practice, and you're likely to get a much better offer. Let's go to the next polling question, Nikki.
Okay, the second polling question we're launching here. The question is, if my firm was to merge upstream or sell in the future, the most important thing I want to accomplish out of the following is. So there's 3 options there. You can just choose one. So select the one that's most important. Either receiving as much money as possible, combining with a firm where the clients and staff will stay, or combine with a firm that allows me to slow down on my terms. We'll keep it open for about 10 more seconds, so take your time to answer. Okay, I'm going to go ahead and close the poll. There's the results. Terry, it's fairly equal in terms of the responses. 40% selected the first option, and then 29% and 32% for the other 2.
Okay. It's a little surprising. I expected actually a little more weight towards the first one. Okay, so again, let's get back to what's the multiple, in essence. And when we talk about the value, that's the first thing we think about, is what's the multiple. But actually, what we're really talking about is a package of terms. So let me give you an example. If someone was to offer you 0.8x times your revenues, and they were willing to write you a check right up front for that, the whole thing was treated as capital gain, there was no retention adjustment whatsoever, that might be actually the best deal you're going to get. On the other hand, if someone was to offer you 10% of collections for the next 20 years, that equates to a 2 times multiple, but very well may not be the best deal for you as a seller. So when you look at the value of the practice, we're really talking about a package of terms, and how those terms fit together actually creates the value of the deal. And there's 5 main variables for valuing a practice. The first of those is the cash up front, if any. That can be very dependent on the time of year we're talking about. So, generally what we see, and we see this all over the place, the range is very high. There's a lot of deals, a very large number of deals that are done with no down payment whatsoever, where all the deal is paid for over time. And usually that time, and we'll talk about that in a minute, how long that time frame is. Generally, if you're going to see a down payment, we're generally seeing the normal range of that down payment somewhere between 10 and 20% of the revenues of the practice. But of course, there are deals out there that are financed externally, and they're generally for smaller practices. And sometimes those down payments can be very high. They can be as high as 70 or 80%. And that generally obviously requires the buyer to go out and finance the deal. We don't see a lot of those in the practices we're involved in, but they are out there sometimes. Well, it depends on the time of year. If we're talking about a deal that closes in November or December, where most of the profits of the practice are going to be flowing in over the course of the next 3 to 4 months, a buyer is much more inclined to give a down payment, a larger down payment than a deal that closes in May or June. Because right now, and this is what we're hearing from people on the buy side of the transaction, I'm going to have to carry this practice at a loss for the next 8 months, and why would I want to come up with a big down payment now? And so there's ways to get around that. Sometimes we'll see down payments where they're delayed until the end of the following tax season. There might be some lump sum payment that's made at that time. The deal's cash flow can have an impact on how much down payment a buyer is willing to make. Obviously, if the cash flow is going to be generous, then the buyer is more inclined to make a larger down payment. Excuse me. On the other hand, if the cash flow is going to be very tight, the buyer is less inclined to make a large down payment. Accounts receivable can be an issue. How they're dealt with in the terms. If the seller is going to keep all the accounts receivable, which is generally the case. Usually when we talk about the value of the practice, we're talking about the value of the intangible assets plus the receivables being an additional value, and oftentimes the seller retains those receivables. But keep in mind, when the seller does that, the seller is basically telling the buyer, now you won't have any cash flow for the next 60 to 90 days while your receivables build back up. Now that's not necessarily the seller's problem, but understanding the impact that has on the buyer's thinking will help understand why sometimes the terms are the way they are. And so sometimes we'll see, and we'll talk about this a little later, we'll actually see sellers who will allow the buyer to use the receivables for a period of time in order to justify a larger down payment up front. The second variable, of course, is the retention, and this might be the most important of all. The 4 different kinds of retention deals that we see, of course, are the standard or classic collection deal. You've heard about 20% of collections for the next 5 years. That's a collection deal, and typically the collection deals are going to extend over the entire period of the payout, unless the payout gets to be 6 years. When the payouts get to be longer than that, then collection deals tend to truncate. The retention period tends to truncate, usually at 5 or 6 years, even though the payments might extend beyond that. A fixed price deal is very rare. It happens, but again, it's very rare because what we're basically asking the buyer to do is just on faith assume that they know what the practice is worth without regard for anything that might happen following the acquisition. I can't tell you that I've seen a fixed price deal in recent years. You certainly see them in internal valuations. If you're buying out your partners in an internal deal, then oftentimes those are fixed at the date of retirement, but there's usually a transition of the duties that's preceded the date that the valuation occurs. But in an external deal, it's very rare to have a fixed price at closing. Usually it's at least a 1-year retention. Guarantee would be some other than a full collection deal, and oftentimes those will be maybe a 2-year or 3-year retention period, even though there might be a 5 or 6 year payout, even longer payout. And then one of the tricks that we've seen used in the past, or we've used, of course, is an economy clause. And an economy clause says that there are certain circumstances under which a client's lost that the seller would have lost that client as well. So say, for instance, if somebody sells their business, or somebody goes out of business, or in the case of an individual, someone dies, that's a client that the seller would have lost under the same circumstances. So if one of those things happens, if we have a limited retention deal, we might say, well, if one of those things happens in the first 2 years, then that, in effect, will adjust the purchase price. But something that happens other than that might not adjust the purchase price. So, for instance, if the reason why the client apparently left was because of the buyer's actions, then that would affect the purchase price, whereas something that happened out of anybody's control wouldn't. That's called an economy clause. The profitability of the deal certainly has an impact on the valuation. And when we're talking about profitability, the first thing we think, of course, is current profitability, your profitability. Although that, in most cases, I mean, it's an indicator really what would affect a buyer's thinking. So let me give you an example of why. Let's say that you're a small practice, you operate out of your home, you basically have no overhead, your wife answers the phone, and you do all the work yourself. You might have a profit margin of 85 or even 90%. That would look like a very profitable practice. And then at some point you decide, you know what, I really don't want people coming to my house anymore. My wife doesn't want to answer the phone anymore. So you open up an office, you hire a receptionist, maybe you hire somebody to help you with the work, and all of a sudden your margin drops to 35%, which would be more normal for a regular practice. At which point in time is that practice worth more to a buyer? It probably doesn't make a difference. I mean, it's worth whatever it's worth based on the client list. So it's not really the seller's profitability that determines the profitability of the deal. It's really the buyer's profitability, the buyer's anticipated profitability. And that can be impacted, obviously, by the overhead that the buyer has to assume from the seller, but it also can be impacted by the buyer's infrastructure. So a buyer that's going to have a more profitable deal is probably going to be more inclined to make a better offer than a buyer that sees the deal as being less profitable. So for instance, a buyer who can move your practice into their space and eliminate all of those occupancy costs is going to have a more profitable deal than a buyer that retains your space. Doesn't necessarily mean that the practice is worth more between one or the other, but it does make it more motivated to do the deal than the other buyer. The implications of the deal structure is definitely an issue. Most sellers, of course, would prefer to have a capital gain treatment because the tax rates are about, 40% of what they are for a ordinary income. On the other hand, most buyers prefer a deal that's treated as a consulting agreement and therefore deductible as paid. Usually this is an issue that can be resolved through negotiating, and what we normally see is about a 20% differential between a deal that's treated as a capital gain deal and a deal that's treated as an ordinary income deal. So for instance, if a buyer was willing to pay 1.1 on a consulting basis, they might be willing to pay 0.9 or 0.95 or something like that on a capital gain basis. And it's just up to the parties whether or not one's better than the other. The length of the payout period, especially if it's a consulting deal, normally there's not interest paid on the deferred payments. So the length of the payout period makes a difference. A deal that has a 3-year payout is obviously going to be much more difficult for the buyer to make any money in the first 3 years than a deal that has a more traditional, say, 5 or 6-year payout. So the longer the payout period, the more the deal, the higher the multiple you might end up having. So the multiple ends up being really the effect of all the other multiples or all the other variables. So for instance, if you have a lower down payment, a longer payout period, and you have a deal that's treated as a consulting deal, and you have a retention period that's stretches out to say 4 or 5 years, then you should expect the buyer to make a much higher offer than a deal that has a very large down payment, has a limited retention period, has a short payout period, and maybe a deal that's treated as capital gain, or where the buyer has to assume a lot of costs that are going to hold down the profitability. So, there's a general cause and effect there. Think about it being a balloon. If you push on one part of the balloon, something else is going to pop out. You still have the same amount of air in there. So there's to the extent that you push on one of those terms, there should be a consequence to something else in the deal. One of the other issues that we see are differences between larger and smaller firms. Generally, a larger firm is going to go for a lower multiple and a longer payout period. That seems counterintuitive. I mean, you want to think that bigger is better, bigger is worth more. The reality is that we've got several things working against that intuition. One is that the larger the firm, the less relevant buyers there are for the firm. So if you're a firm that has, $5 to $10 million in revenues, chances are a relevant buyer for you is going to be in the, $20 million range, $10 to $20 million range. Well, how many of those do you have in your market? Usually not very many in most markets. So therefore, there's not going to be a lot of options for that firm. It's going to be harder for them to command a premium. Whereas if you're in a practice that has, $400,000 to say $750,000 of revenue, there will be dozens in a large metropolitan area, dozens, if not, even a multiple of that, relevant buyers for that particular practice. So we have a supply and demand issue there that comes into play. The more buyers you have, the higher the price is likely to be. The other thing that happens is that in a smaller practice, usually it can be absorbed into a buyer's practice with very little incremental overhead increases. So for instance, if you have a practice where you have 5 employees and the buyer happens to have 5 empty spaces in their office and they can move you in with no need to invest in additional infrastructure, needless to say, there's a tremendous amount of cost that they've not had to incur. So a firm that is able to be absorbed easily into another practice without any incremental overhead create a much more profitable deal for the buyer and therefore a higher value. It's unusual for a practice that has, say 25 to 50 employees. It's pretty hard to absorb that practice without incurring incremental overhead. Generally, retention periods in the larger deals are going to be different because of the partner loyalty issue, the client's loyalty to a partner. So the smaller the practice, the more likely the owner of the practice is going to have a personal relationship with more of the clients, and therefore the transition of the client base is more dependent on that particular partner's transition plan and his or her individual actions. In the case of a larger firm where you have more brand loyalty, where the client is more loyal to not just one person but to that firm, as long as we can make the client comfortable that that brand has not been affected in a negative way by the merger, they're more inclined to go along with it. So there's less risk for the buyer in a firm that has more brand loyal clients, and therefore they may be more inclined to go with a shorter retention period. Larger firms traditionally are never a total sale, but a combination of a sale, a merger, and a two-stage deal. We're going to talk about two-stage deals in a minute. But generally, if you've got 4 or 5 partners in a firm that are selling or merging into another firm, you're going to have, each of those may end up with a different kind of deal depending on what their transition is. So if we have a partner who's going to leave in the next 12 months, we may treat his interest as a total, as an immediate sale, whereas a partner who's going to be around for 15 or 20 years, of course, would come in probably in more of a merger. So let's talk about some of the alternative deal types. Generally, there are 4 different deals fall into 4 different categories. There's the outright sale, two-stage deal, a cull-out sale, and then, of course, a merger. In an outright sale, the purchase payments begin immediately. So we turn over the practice. The buyer starts managing the clients. And the seller, if they stay on, usually stays on in some kind of a per diem basis. If they get paid at all, depends on what their role is going to be. Sometimes their only role is to manage the transition of the client base, so they get paid, basically they're getting paid for doing that by selling the practice. And so their role is only to make the introductions of the new clients and to answer any questions that might come up and then assist with any retention issues that might come up. The big disadvantage with an outright sale is the fact that we're not leaving enough time for the transition, so that when that can lead to a lower client retention. So in an outright sale, keep in mind that the seller is really not involved with the practice on a significant basis following the sale, and therefore the clients aren't given time to acclimate in a gradual way to the successor firm. This is, generally the issue here is that if you try to do an outright sale and you ask the seller to continue working full-time, in the practice, in the role they had before, the only way that you can make the payments to the seller on the for the purchase payments and still pay them is to pay them less money. And that's typically what happened when I used to be with Arson McGladrey doing deals. That's generally how we had to structure deals, because all we could do was outright sales. We were a public company and we had to follow certain criteria, and therefore the only way we could do the deal was through an outright sale with an adjustment in the seller's compensation. So the big disadvantage is not having that period of time during which the seller and the seller's clients are gradually assimilating into the buyer's practice. But of course the advantage is that you start getting your payments right away. One way that we deal with kind of an interim or kind of a bridge to a merger is through a two-stage deal. Stage one is usually up to 5 years. The seller, you, merges into the successor firm, and it's held out to the public and even internally as a merger, even though contractually it's not really a merger because you don't get equity in the new firm. You start the transition process immediately. So let's just imagine, say we've got a 3-year stage one. During stage one, you're going to spend the next 3 years gradually assimilating the clients into the successor's practice, so that by the time that stage one is over in 3 years, the day that you slow down or leave the practice altogether, the issue of retention is really a done deal. The client's already made their decision to stay with the firm, is comfortable with who their successor is going to be, and the retention can be a lot higher. During that period of time, usually you're going to maintain reasonable control over the clients, meaning you're probably the day-to-day managing partner of that client base. I mean, you're not the managing partner of the firm, but you continue to manage the services, make billing decisions, make service decisions, assign staff and so forth, just like you always have, but you're doing it within the confines of the successor firm's practice. You take on a principals or a non-equity partner role, and the most important thing is you maintain your compensation level. So oftentimes what we'll see is that we'll take, if your compensation has been, say, at 40% of your revenues, then oftentimes we'll set your compensation at 40% of the collections from your client base during this stage one, so that you maintain your compensation. Got a question here. Do these terms apply to a new partner buy-in to an existing practice? And I would say that no, they don't. I mean, the differences between a buy-in for an existing practice and a new partner and one that is an external deal is entirely different. And there's a different webinar that we will offer on partner buy-ins, I think later this year. And I know there's one recorded on our website as well. But getting back to the two-stage deal, the most important thing here is to understand is that during stage one, you maintain your compensation level as long as you continue to work in a full-time role. Okay, I can't get past this. There we go. Okay, stage two is when you start getting paid for the practice. So again, going back to the 3-year stage one deal, at the end of 3 years, or sometimes it's earlier, we decide to truncate stage one. You either slow down or go into a completely retired role. If you continue to work, you're probably doing it at a per diem rate, which means usually maybe 1/3 to 40% of your billing rate. And now you're getting paid for a practice that has already transitioned. So a lot of the retention issues, a lot of the retention risk is eliminated because the clients have already become assimilated with the new firm, and as long as you've done a good job of introducing those clients to your successor within the practice, the risk of attrition is much lower. A cull-out sale is where we're selling part of a practice or retaining part of a practice. So an example of this would be, I just had a situation come up the other day where a seller had a portion of the practice. It was about $1 million practice, and they had about $100,000 of business clients that the buyer didn't want. And the seller really enjoyed doing it. And in fact, the seller, that portion of the business, the seller did almost 100% on their own. They didn't use staff for that portion of the business. And the way we overcame this issue of, well, I really don't want that portion of the business, was the seller decided, you know what, I'm going to keep doing that on my own, so I'll just carve that out of the $1 million, and I won't sell that. So now I'm selling a $900,000 practice. I'll continue to operate that portion of the practice while, you know, I'm in the stage 1, and then when I get to stage 2, I'll just, you know, our deal will allow me to keep doing that work on the side. It actually made the deal a little more profitable for the seller because that $100,000 practice ended up being $100,000 of profit. So whereas they were making, say, you know, $350,000 or so on the $1 million practice, they now retained $100,000 of that profit and were able to sell the $900,000 at really no discount to the buyer. So that's an example of retaining part of the practice. An example of selling part of the practice, and this often happens in a multi-partner firm, is that we'll have, say, an office that we don't want, that's run by one partner who wants to retire. Nobody really wants, they don't have a successor in that office. We might sell off that office to another firm as a separate unit. So the Cull-out sale can be clients, could be services, could be locations. And basically you're staying involved with the sole clients oftentimes while you're operating. If you do a retention deal, where you're retaining part of the practice, oftentimes you're actively involved in the practice enough that it assists in the overall retention of the practice, even though you're in stage 2. So I think a Cull-out sale oftentimes works well. Just to make a differentiation between a sale and a merger, the key difference is the ownership status. In a merger, the selling partners become partners and equity partners in the new firm. They sign on to the acquirer's agreement. Those terms dictate your terms. So in effect, when you talk about, well, what was my practice worth? Well, it will be defined by the owner agreement of the new one you signed, the successor firm's owner agreement. So if they're going to pay you, say, you know, 3 times your compensation over 10 years, that's what your portion of the practice was worth. It was dictated by those terms. Should you even seek equity? Well, we'll talk about that in a minute. Let's go on to the next polling question.
Okay, we're launching our 3rd and final polling question now, so be sure to take a moment to complete it. This question is, in the next 5 years, which of the following is most likely to occur in your firm? So again, there are 3 or 4 options this time, and you'll just select the one. We'll leave it open for another 20 seconds or so to give everyone time to vote. Okay, we'll go ahead and close the poll. The results are visible there. Terry, it looks like 52% indicated that they don't expect any changes during that time frame. 23% said merge upstream or sell, and then 18% for acquiring another firm, and 7% for retire and be bought out by partners.
Interesting. That's not what I expected from this group. Maybe I talked you out of something, huh? We have another question I want to answer real quick. Somebody asked, what methods of valuation will a purchasing party use to drive the lowest price? Tends to be the higher valuation, capitalized earnings as an alternative, excess earnings, discounted cash flows. You know, I did operate for about 6.5 years in a public company, acquiring accounting firms for that company. And you know, from the standpoint of our point of view, we use capitalized earnings. I mean, we would pro forma the earnings of the acquired firm, and we would multiply that times, you know, the EBITDA multiple of somewhere between 4 and 6, and that's how we valued the practice. But in terms of how we presented that to the selling firm, it was always presented as a multiple of revenues. Now, we did have, you know, a discussion about profitability and multiples of profits, but from the standpoint of what the sellers expected, it was always in a multiple of revenues. I can tell you that, you know, that's the way people communicate about value with accounting firms. It's always, and if you think that you can get away with saying, well, I'm paying you X times earnings, but that turns out to only be 0.6 times revenues, it's probably not going to be a deal that's going to fly. So, you know, you really need to think about, you know, there are several people I know that operate the way we did when I was with a public company, and when they get to situations where their required multiple of revenues doesn't result in a high enough multiple of multiple of earnings doesn't result in a high enough multiple of revenues, they generally walk away from the deal because they know they can't make it work. So even though, we might say, well, gee, 6 times EBITDA is a pretty high valuation, the reality is if that doesn't get to the right multiple of revenues, the seller probably isn't going to be accommodating. Hopefully that answered that question. Okay, tricks and tips. Should you ask for as much upfront as possible? First off, how do buyers view that issue? Well, the more money you ask for upfront, the more you're going to ask the buyer's going to have to borrow. I don't care who it is. I mean, obviously, if you're a $1 million practice and you're selling to a $100 million firm, they probably wouldn't have to borrow. But most buyers who are buying a practice are generally in the range of 2 to, say, 5 times the size of the seller. And usually, when you ask for a large down payment, it's going to come from one of 2 places. Either they're going to borrow money, and most accounting firms, you're probably one of them, hate to borrow money, or it's going to come out of their partner's compensation, and most people hate to, reduce their compensation in order to do anything. So it's the more that you ask for up front, the more pressure you put on the deal. Buyers who are willing to do large down payments generally will come back with some other consequence, which oftentimes is a lower multiple. So, asking for a large down payment can result in, unintended consequences. And what are you really gaining anyway? If we paid you 40% up front and paid you the rest, the other 60% over the next 5 years, or we paid you that whole 100% over 5 years, how much more money did you get? You didn't get any more money. So, you didn't really accomplish anything. What you think you might have accomplished is, that you created less risk for yourself because you got, well, at least I got my 40% up front. But when you think about it, if you were really, really willing to settle for 40% up front, you're probably talking to the wrong firm. So I think that, pushing on down payments makes it difficult to find buyers to do the deal, has unintended consequences. And as I said before, sometimes you can use your receivables as an offset against the down payment. Should you shorten the retention period as much as possible? Well, is a 1-year retention deal better than a 2-year retention deal? We have found that when you have a 1-year retention deal, the risk from the buyer's perspective is so high that they tend to do things to make sure that the client that they bought doesn't leave after 1 year, because that's the worst case scenario. So a client comes in, it's a $5,000 client, they stay 1 year, they leave, we end up paying $5,000 and only had them 1 year. So buyers tend, in those cases with 1-year retention deals, tend to have extremely aggressive transition plans to make sure that that doesn't happen, which tends to actually cause more attrition, not less attrition. And what message are you sending to the buyer when you tell them, gee, I'm really concerned about the retention issue here? What you're really saying is, I don't think you can keep my clients. If you don't think you can keep your clients, why would the buyer think you can keep your clients? So a 1-year retention deal is potentially a negative. It's better maybe to use limited retention deals, maybe go for a 2-year at least, or maybe a 3-year retention deal, even if it's got a 4 or 5, 6-year payout. And of course, we talked about the economy clause already. The other thing to keep in mind is replacement clients. Sometimes, in the longer the retention, say we've got a 5-year deal, and a 5-year retention deal, sometimes the buyer will allow you to replace lost clients with new clients, as long as you're not increasing the purchase price by doing that. So, if you can continue to do what you do now, which is replace your clients with new ones, then sometimes you can maintain the value of the practice that way. How can you increase your value through the buyer's profitability? Well, eliminate as many must-haves as you can that cost the buyer money. Make your employees as flexible as you possibly can in terms of, if you've got people that are expendable, kind of resolve yourself to the fact that maybe it's okay if they don't come along with the deal, or don't make them, at least don't try to get them some kind of long-term commitment. You don't have a long-term commitment for them. You don't have an employment contract that says they can't be fired for 2 or 3 years. Don't expect the buyer to do the same thing. Try to make your leases as flexible as possible. Sometimes they can be sublet. Sometimes they can be sublet even if it's at a loss. It's better than losing the whole deal. Let's say you've got $1 million practice, typically your lease payments will run somewhere between $60,000 and $80,000 for that practice. If you have, say, a 5-year lease left and you can sublease it at 80% of that, how much is that really? We're only talking about, maybe a $50,000 cost. And it's possible that by doing that, you can actually increase the value of the practice by more than it cost you by making that lease not a problem for the buyer. Should you go after capital gain treatment? Well, again, we talked about the trade-off between the goodwill and consulting. You can go for capital gain treatment, but do expect that there will be probably a lower multiple on the deal. And if you do end up with a consulting deal or decide that's the best way to go, both parties decide, oftentimes you can do that by maintaining the entity that you're selling the practice from, having the payments go into that entity, paying yourself with extravagant types of fringe benefits and other types of we have seen some buyers or sellers actually set up defined benefit retirement plans to basically wash the money through in a tax deferred and a way that doesn't create any kind of payroll taxes. So try to create some kind of aggressive tax shelter within the old entity that you're selling in order to minimize the tax cost of consulting payments. Using longer payout periods. If you're willing to accept your payments over, say, 10 years, then you can make the case to the buyer that, well, you're amortizing it over 15 years. There's not that much difference between what you're paying me and what you're deducting. Why don't we go with a longer payout period, and therefore I can get capital gain treatment. Is it better to go for a shorter payout period? Well, again, keep in mind that the buyer's cash flow is going to be decreased to the extent that you're pushing on the payout period, and what are you really gaining anyway? Some buyers would rather pay you a 1.2 multiple if they can do it at 20% a year than pay you even 0.9 if they have to do it at 30% a year, because that 30% a year might actually put them into the red for those 3 years. That's kind of an extreme example, but oftentimes that's the way that buyers think. When you look at what your merger partners should look like, start with the 4 C's: culture, chemistry, continuity, and capacity. Make sure the culture is consistent with your client base and your staff. Chemistry between you and the buyers. There's a continuity that's going to be created in your practice with as little change as possible. And the capacity that the buyer has to replace you. There's a couple questions here that we haven't gotten to. We're running out of time. I'm going to give the answers to these questions to Nikki, and she will include them and we will include them in a follow-up email to everybody so that everyone can see the question that was asked and see a more extensive answer than I can give at this time. So at this time, I'm going to turn it back over to Nikki.
Great, thanks, Terry. So just a reminder, we've got folks on the call today who registered directly with transition advisors and others who registered through CPA Academy. If you registered through CPA Academy, you'll receive your CPE certificate that way. But if you register directly with transition advisors, you'll see an email from me this afternoon that will include a link to a survey. You'll need to complete that survey, and then I will issue your CPE certificate. If you have any doubt about how you registered or any questions at all, feel free to contact me. My email address is njohnston@transitionadvisors.com. If you have any questions about the content of today's webinar, please feel free to follow up with Terry directly, and you see his contact information, including our phone number there on the screen. Just another brief reminder that there is a brief survey that pops up right when we end here. That's not what's required for CPE purposes, but it does help us to address any topics that are of interest and gives you an opportunity to request today's slides or articles with additional information. So all of that said, we thank you very much. As Terry mentioned, we will get out a follow-up email to everyone from Terry in the next couple days that will address any questions that we didn't have time for today. All right, thank you very much for attending, and we hope that you'll join us for another webinar.